All right, Pete. Welcome back. Uh, I want to go down a rabbit hole today because I think this is an area that you have some expertise in. I want to understand why the financial sector is the worst performing.
Sure. Yeah, it performs the worst in the first quarter of 2026, at least for the U.S. market with the Standard and Poor's 500 index. I think a large reason for that is the financial sector tends to perform well when the economy performs well, and vice versa. It tends to lead the pack on the way down when markets go down. The reason for that is how much leverage the financial institutions use. We all know about the leverage in the banking system, but many of these financial institutions are highly levered. You've got insurance companies get that in the form of unearned premium reserve or actuarial reserve, depending on whether they're property and casualty or life, respectively. And that's just them collecting cash before they've actually provided the insurance. You've got CLO funds, collateralized loan obligation, that are sometimes levered 10 to 1, $10 of debt for every $1 of equity, just to get the 50 or 100 basis points a month of return. So there's many examples like that where the institutions themselves are borrowing a lot of money, and so slight movements in the macro economy, they're very sensitive to the macro factor.
Yeah. Now, you know the next thing I'm going to ask. What's the opportunity there?
Yeah, I think the opportunity there is, at least in US markets, the financial institutions as a group are on sale. They weren't super expensive before the year started, but they're now even cheaper. And one thing to remember is the macro economy can shift quickly. So if you see positive news that like the war in Iran is coming to an end, for example, you could see a run up in public securities, and financial institutions could easily lead the pack just because of how much leverage they take. They tend to profit from times of stability.
Mm, that makes a lot of sense. It also highlights a confusion that I've always had, and maybe it's more of a frustration than a confusion, but that's how much the markets are subject to social sentiment, right? So when people feel good about something, their behavior changes things in the marketplace, and then as a result, it impacts valuations of companies, valuations of stocks, et cetera, et cetera, et cetera. And I think it's something that a lot of people don't understand. And earlier in my career, I was like, that's why sometimes playing the market feels like going to Vegas. Like, what are your insights on that?
Yeah, I've heard that before. It sounds a lot to me very similar to what someone like George Soros would call reflexivity, where the changes in the market cause behavioral moves that in turn affect the real economy, and that real economic impact then in turn affects the securities again. So it's a loop there. I've seen this in financial services companies. So a good example is 2008 with the banks. The accounting rules were different than they are today, such that the mortgages that these banks held, some of them were not really impaired and showed no signs of impairment, but they still had to be marked down as if they were impaired. So you had bank CEOs selling mortgages at fire sale prices for personal rational reasons. I'm a CEO, I want to look good to my board, I'm selling indiscriminately, you know, as many mortgages on the bank's balance sheet as I can, even though that may not have been in the interest of shareholders. So there's definitely situations in financial services where behavioral um, issues for management can destroy shareholder value. And so,
Mm.
yeah, I agree. Definitely, there's a reflexivity there that comes up from time to time.
So again, in these moments, there's always opportunity. There's always something to uncover when there's a flux in any market. Doesn't matter where it is, what the conditions are, there's always an opportunity. Are there extra opportunities that you're seeing as a result? And baked into that, I also want to know your predictions on where the market will go as a result of whether or not some of these trends continue, whether or not the market stays stable, so social sentiment stays high, and so on.
Yeah, there's opportunities. Even some of the large financial institutions, large cap, trade fairly cheaply. I'll give you an example. There's a company called Reinsurance Group of America, ticker RGA. It's the largest life and health reinsurer in the U.S. by premiums written. Trades around book value. There may be some opportunity there, and it's below its like 5 year average of where its price to book ratio has been by about 20%. There's opportunities like that investors may be able to take advantage of. Obviously, you have to do a lot of underwriting and due diligence to understand whether the companies are cheap or cheap and represent value. But definitely, there's opportunities there.
Yeah, absolutely. Um, so what uh, sometimes when we talk about opportunities, things to uncover, I'm just curious from your perspective, opportunities for who? Who are the individuals that are uniquely positioned to take advantage of these shifts?
I think investors that are patient, investors that understand the value of these financial institutions and how profitable they can be, and investors that are not subject to sort of the voting machine of the market. They're not over levered themselves, and so they don't have to fire sale something to meet a margin call. So it can be good for that long term value oriented investor who understands the space.
So not for the day traders and not for the renegades that want everything in rogue stocks is what I'm hearing.
Correct. Yep, that's right.
Yeah, that makes a lot of sense. So it's long-term long-term centric investors. Um, what other opportunities are you seeing, or what trends in the market for this particular type of investor should we be paying attention to?
I think one of the trends that is also worth paying attention to, in addition to the war and the impact of that on the macro environment, is of course always interest rates. Financial services companies tend to be sensitive to the changes in interest rates, and not necessarily automatically good or bad in one direction.
Mm.
Each you gotta look at each company and see how it's matching what's called the duration of its assets to the duration of its liabilities. Duration is a measure for interest rate risk. So, for example, back in I think around 2022, 2023, that time period, there were a lot of banks that performed poorly because they had low coupon, long duration treasuries against sort of short dated floating rate liabilities, which didn't work well in a rising interest rate environment. But then there were also some banks that didn't make that error. So, for example, JP Morgan Chase was not overexposed to these long dated instruments at very low coupons, and they were able to be actually a source of strength for the industry. So they bought First Republic around that time and things like that. So just the interest rates for sure.
Yeah, I think that's a very, very big one. Interest rates, and then I don't think we've talked about this before, but inflation is definitely a lever, and it's a pressure point. And I think it's one that I don't remember if we've ever talked about it, but it's miscalculated in my opinion. It's something that we have a pretty version that we put out in the press, but it's not the actual version. And it impacts us as investors in a completely different way than we realize if we're not paying attention.
Mm-hmm. Yeah, certainly. Inflation's a big risk, and that can cause you to rethink where you might want to be within the capital stack. If you're in a fixed income or first lien senior secured bank debt position, you got to make sure you're earning enough of a coupon rate or an interest rate to pass inflation. And if you're not, then the market will start having those securities trade at a discount so that the yield to maturity is higher, a discount to par. Um, the other thing to think about is in the U.S. Market, there's something called Treasury inflation protected securities. These securities, their face value increases when the future realized inflation rises above the current implied inflation. But when that happens, the government taxes away the inflation. So the investor, if they can, should think about tax efficient areas to store these treasury inflation protected securities in, whether it's a 401k, health savings account, things like that. Um, it's ironic that the instrument designed to protect you the most from inflation in the US dollar actually doesn't protect you from it because of the taxes.
That is fascinating. And I don't know if I dare say disturbing, but that is fascinating.
Yes, sir.
um, Pete, you've actually shared some, I mean, you've dropped some real knowledge nuggets on us. And you've highlighted some areas that I think most people don't pay attention to. And maybe for some individuals, it's something that we don't need to pay attention to if we got someone in our back pocket like you. But I do want to ask, just kind of wrapping to a center point. What is the strategy right now that you are most excited about, that you'd love to talk to people about?
I think for me, at fourth quadrant, we run a financials focused fund. I think deep value within that sector is something that I'm excited about. These stocks have been cheap for a long time. Many of them they've gotten cheaper in the recent 3 to 4 months. I think that's a really good area that's under allocated to, in my estimation, and we're gonna see some. I see some good opportunities, and I think those will come to fruition in the intermediate term.
Love it. Love it. Well, again, thank you so much for sharing really, really invaluable information with us. Looking forward to, big things coming from you. Where do people find you, by the way?
Yeah, they can email me, Pete J. Dunn at fourthquadrantassetmanagement.com. They can give me a call at 832-623-2015. I do ask, if you call me and I'm not able to answer, please leave a voicemail so that I know who it is. I get a lot of scam calls, so I wouldn't want to mistake a legitimate call for a scam.
It is that reason that I personally force people to text me so that I know precisely what it is. Um, yeah, also have massive busy schedule, as I'm sure that you do as well. But thank you for spending time with us. Thank you for sharing, and we'll catch you next time.
Yeah, my pleasure, Levi.